Measurement of national income method. The income method calculates the national income based on factor incomes. The incomes received by every resident of a country for the productive services provided by them during a year are added together to determine the national income of an economy. In other words, under the income method of calculating national income, all incomes of a country accruing to the factors of production through rent, wages, profits, interest, etc., are added up together for the determination of national income. This method is also widely known as factor payment method or distributive share method. The total of all the income earned by factors of production within a domestic territory of a nation is known as domestic income, that is NDPFC. Components of factor income. Number one, compensation of employees, COE. COE refers to the amount paid to the employees directly or indirectly by the employer in exchange for their services. It includes all kind of payments and benefits received by the employee directly or indirectly. COE consists of three elements. Compensation of employees, COE. COE consists of three elements. One, wages and salaries in cash. It consists of all monetary benefits like salaries, wages, bonuses, commissions, DNS allowances, etc. Number two, wages and salaries in kind. It includes all non-monetary benefits like health and education facilities, rent-free accommodation, free car, etc. An imputed value of such benefits should be calculated in national income. Number three, employers' contribution to social security schemes. It consists of the employer's contribution to the employee's security. For example, contribution in gratuity, provident fund, labor welfare fund, etc. The main aim of these contributions is to ensure employee security. Number two, rent and royalty. Rent is that part of the factor income that arises from ownership of a land and building. Rental income includes both actual rent obtained from let out land and imputed rent obtained from self-occupied land. The imputed rent of a self-occupied house is calculated at the market value of that house. Royalty refers to the income earned from granting leasing rights for self-owned assets. For example, the mineral deposits, coal, natural gas, iron ore, etc. owners can earn more through royalty by giving mining rights to the contractors. Interest. Interest refers to the income earned from lending funds to production units. It includes both actual and imputed interest provided by entrepreneurs. Interest income consists of the interest on loans taken for productive services. It doesn't include interest paid by from another, interest paid for loans by a consumer taken for consumption, and interest paid by government on public debt. Profit is the income or reward of the entrepreneur for his contribution to manufacturing of goods and services. In other words, it is a residual income that an entrepreneur earns after paying off all the factors of production. The profit earned is used for three purposes. The profit earned is used for three purposes. Number one, corporate tax. It is a tax paid by a firm to the government for the profits earned by them in a particular period. It is also known as business tax or profit tax. Number two, dividend. Dividend is a part of profit given to the shareholders in their shareholding ratio. It is also known as distributed profits. Number three, retained earnings. It is that part of the profit that is kept aside as reserve to handle the uncertain situations that may arise in a business. It is also known as reserves and surplus or undistributed profits or savings of private sector. Profit is equal to corporate tax plus dividend plus retained earnings. Operating surplus. Operating surplus is another term used in factor payments. It is the sum total of income from property, that is rent, royalty, and interest, and income from entrepreneurship, that is profit. Operating surplus is equal to rent plus royalty plus interest plus profit, or equal to value of output minus intermediate consumption minus compensation of employees minus mixed income minus consumption of fixed capital minus net indirect taxes. Operating surplus arises in both government and private enterprises. However, it does not arise in general government sector as they operate for the benefit of general public. Therefore, factor income is nil in general government sector. Number five, mixed income. It is the income generated by unincorporated enterprises such as small shopkeepers, retail traders, etc., and own account workers like farmers, barbers, etc. The term mixed income is used for any kind of income which has more than one kind of factor income. It arises from self employed workers, productive services. The income of these workers includes profit, rent, wages, and interest and cannot be separated from each other. For example, a tutor giving tuitions at his residence. And finally, the calculation of income method formula, compensation of employees, that is rent and royalty plus interest plus profit plus mixed income, will give you domestic income NDPFC plus added NFIA will give you national income NNPFC.